What's happening with some stocks which are falling sharply but have for months done incredibly well? Take something like a Novo Nordisk, okay? The maker of Wegovy and Ozempic. It dropped 20% and it got punished. It's not the first one. There's been many other companies which have dropped 20%, 15% in a day. Now, several points to make about this. First of all, it's a useful reminder that you might want to look at exchange-traded funds and not individual securities, because the volatility on an individual security is generally far greater than on an exchange-traded fund, all other things being equal. That's the first thing. Secondly, you might want to look not at percentages, but the amount of money in an individual security. If you've got 5% across 20 stocks, that's one thing. If one of them drops 25%, it impacts your overall portfolio by 1.25%. But if you've got 40 securities with 2.5% in each, then of course you've got less exposure. Even though the 25% drop impacted you, it impacted you half as much. And people look at percentages, sadly, not money. So I would say 20 to 40 securities is the ideal number in a collection of both ETFs and stocks. And it's a time when the market's falling, and what's happened to Novo, that people realize, whether it was a Novo or anything else you owned, that actually I think I want to hold perhaps less securities, individual securities, more exchange-traded funds, for instance. And that's a good thing, because the sooner you align your risk appetite to your holdings, the better. So we all want to cry at our inner child saying, oh my God, I thought I was going to get rich quicker. I thought the markets only go up. I want my candy, and why is it being taken away from me? And I just bought that second home in the Bahamas. But now I realize that it's not that simple. And really the most successful investors, and if you don't take me, I mean, I've written about it in my various books and so on. The most successful investors, like Warren Buffett, end up at times when they can't find the right opportunity to suit their risk profile holding a lot of cash. So be it, because they can't see into the future. And if Warren Buffett can't see into the future, what hell chance for the rest of us? And it's that sad patience which makes our inner child go, oh no, but I don't want to be patient. I want my money now. I want it now. I just want to be rich. I thought this casino was the way I was going to go. And the shorter the time frame you have and the more money you want to make, and somebody once wrote to me when I was writing my column in the Financial Times about this, saying, I need to make a lot of money in a short space of time. And I thought, well, you and everyone else make. The greater the risk, the more you're speculating, the more you're gambling. Okay? If you compress time, and you extend return, you're gambling, right? So the best way to do it is actually to reduce the amount of capital in each holding and have a basket like an exchange-traded fund. And exchange-traded funds, by the way, are not active funds. The way actively fund-managed funds, the way, the rubbish that goes into your pension thanks to, I'm going to say it, St. James's Place and IFAs, these are trackers, and they're cheaper and they just work out better. Of course, you can create your own bespoke one to suit you, so let's say your name's John Smith. The John Smith Exchange Traded Fund is, say, 50 stocks and some other funds, but bespoke to you. And I want more people to do that and put it in their SIPP ISA and be their own fund manager, because it is straightforward to do, but at least you've got the transparency of knowing what you do, what you stand for, and the simplicity of it all. Anyway, the bottom line points I want to make about some of the falls is the market is really punishing companies at the moment, good companies. So why did Novo Nordisk get punished? So I looked through the numbers. Apparently, the expectation of its latest fat-reducing drug was that it would lower weight by 25% over a period of time. It didn't. So you would think it gets punished for that. Rightly so, lost 20% of its value. No, let me finish the sentence. It didn't reduce it by 25%. It reduced it by 22.7%. Now, listen, speaking as a fatty who's on Wegovy, I can tell you, if you bloody reduce my weight by 5% or even 10%, get me down from 90 kilos to 81 kilos, I'll be back at wedding weight. I will be jumping around. So the market is punishing these companies, not on valuation, not on even momentum. There is a degree of panic. There's a degree of, well, if you're not as good as NVIDIA, then you're all getting shafted. That irrationality is not necessarily a bad thing. It just means that if, like me, you're patient and you've got perspective, then you can just say, all right, you scrap it out. I don't need to act. You don't need to act. You can sit on your hands. So a lot of academic research done on this, that men prefer to be traders. They prefer to prefer to mess around with their portfolio too often. I've written about it in my book, Trading Online, which is an international bestseller. Just trying to build up my credentials there for you. Let alone the fact that we practice this in the hedge fund. Most of the time we don't have to do anything. And yeah, you get paid for that. Women tend not to be as bad as men at that, and women make better investors. So you might want to run some of this stuff by your spouses, by your wives, by your girlfriends, by your female other halves. Okay, thank you. Hopefully you found that interesting and useful. Thanks.